Welcome back to Descript with Henry, where we unpack the future of money and digital innovation. Today's hot topic, crypto regulations around the world. From the US to Asia to Africa, countries are rewriting the rules of finance. And as always, I'm joined by Henry.
Great to be here, Lisa. And yes, regulation is the elephant in the crypto room. It can either unlock massive innovation or shut down entire ecosystems.
Let's start broad. What's the global landscape like right now for crypto laws?
It's fragmented, like a digital Wild West with borders. Some countries embrace crypto, others ban it, and many are somewhere in between. But the common trend in 2024 and 2025 is convergence. Nations are finally realizing they need clear, enforceable, and innovation-friendly rules.
Give us the big players. Who's leading and who's lagging?
Sure, the European Union is leading with its MyCar regulation, markets in crypto assets. It's the first comprehensive crypto law in the world, covering stablecoins, exchanges, and even marketing practices. It sets a high bar.
My car is already live.
It's rolling out in phases. As of mid-2024, stablecoin rules are active, and full compliance for exchanges kicks in by early 2025.
And what about the US?
The US is complicated. Crypto regulation there is split across multiple agencies: the SEC, CFTC, IRS, and more. The SEC continues to treat many tokens as securities, which has sparked legal battles with firms like Coinbase, Ripple, and Uniswap Labs. Congress is still debating broader legislation, but political divisions slow things down.
Sounds chaotic.
It is. But there are bright spots. Some US states like Wyoming and Texas are becoming pro-crypto hubs with their own regulatory frameworks.
What about Asia?
Asia is fascinating. Singapore remains a regulatory gold standard, strict but clear. Exchanges must register under MAS, Monetary Authority of Singapore, and meet anti-money laundering rules. Meanwhile, Hong Kong reopened its doors to retail crypto trading in 2023, hoping to reclaim its status as a Web3 capital. Japan has a mature framework that protects users and allows innovation.
And then there's China.
China has banned crypto trading and mining outright, but is all in on CBDCs. Their digital yuan is already live in dozens of cities. So while they ban private crypto, they're betting on state-controlled digital currency.
Interesting contrast. Any surprises globally?
Yes, the UAE, especially Dubai, is becoming a hotspot. Their VARA, Virtual Assets Regulatory Authority, creates a clear path for crypto firms to operate. They've attracted exchanges, wallets, and even token projects from around the world. Also, Australia is advancing its own regulatory licensing regime, aiming to become a crypto-friendly financial hub.
So are we moving toward global coordination or more fragmentation?
A bit of both. There's an effort, especially from the IMF, G20, and FATF, to create common standards, especially around anti-money laundering, AML, and taxation. But national interests still dominate. For example, while Europe is liberalizing, countries like India impose steep crypto taxes, and Turkey is drafting restrictive laws after a series of exchange collapses.
That makes the market unpredictable, right?
Exactly. For investors and builders, legal clarity equal with confidence. When rules are vague or changing, capital stays on the sidelines, but when governments provide a clear legal framework, startups, investors, and even banks are more willing to participate.
Let's break it down for listeners. What should people look out for when judging if a country is crypto-friendly?
Great question. Look for these 4 factors. 1. Licensing clarity. Is it clear who needs a license and how to get it? 2. Tax treatment. Are crypto gains taxed fairly or punitively? 3. Exchange support. Are local exchanges allowed and regulated? 4. Innovation stance. Does the government encourage Web3 or just tolerate it?
And we'll dive deeper into those in the next part, right?
Exactly. Next, we'll explore how emerging markets are becoming global test labs for crypto regulation, and in some cases, even leapfrogging developed economies.
We wrapped up the first part with an overview of how countries are approaching crypto regulation. Let's now shift to emerging markets, Henry. Are these countries catching up with global trends?
They're not just catching up, they're often leading in innovation. While developed nations are still debating regulations, many emerging economies see crypto as an opportunity to leapfrog outdated financial systems. Countries like Brazil, Nigeria, Kenya, the Philippines, and Vietnam are making serious moves.
Vietnam? That's interesting. What's going on there?
Vietnam ranks among the top countries in crypto adoption. While there's no comprehensive legal framework yet, the Vietnamese government is taking crypto seriously. In 2021, the Prime Minister directed the central bank to study a pilot for digital currency. In 2024, the Ministry of Justice began drafting a legal framework for digital assets.
So it's not officially legal, but not banned either?
Exactly. The government is watching the space carefully. And the local Web3 scene is incredibly strong, with notable projects like Axie Infinity and domestic crypto funds. This grassroots momentum forces the government to act rather than ignore it.
What about Brazil? I heard they've been moving fast recently.
Brazil is a rising star. The National Congress passed a crypto regulation bill in late 2022, which took effect in 2023. It recognizes cryptocurrencies as digital assets and requires exchanges to register with Brazil's central bank. In 2024, Brazil also launched Drex, a digital real, to complement the crypto ecosystem.
Are stablecoins allowed there?
Yes, and they're actually encouraged. The government sees stablecoins as a tool for financial inclusion, especially in underbanked regions. That's quite similar to what's happening in Nigeria.
Nigeria, Africa's leader in crypto adoption, right?
Correct. Although the central bank initially banned crypto transactions in 2021, that stance reversed in 2023. Nigeria now allows regulated institutions to offer crypto-related services. They've also launched the Naira, their central bank digital currency.
So these countries are pursuing both public CBDCs and private crypto markets?
Exactly. It's a dual approach. In Kenya, for example, the government is running regulatory sandboxes for fintech startups, including crypto. It's a way to experiment and learn before drafting formal laws.
It seems like these emerging markets are more agile than the developed world.
Absolutely. They have fewer legacy systems to disrupt. For them, crypto is a way to expand financial access, reduce dollar dependence, and attract foreign investment.
Sounds like a leapfrog strategy through tech?
Spot on. The Philippines is another example. The government is testing blockchain-based remittances, a major part of their economy. And the Securities and Exchange Commission requires crypto firms to register and comply with local rules.
Any major risks in this test and learn approach?
Sure. The biggest risks are inexperience, vulnerability to scams, and overdependence on specific tokens. But with smart sandbox models and proper oversight, these countries could become models for crypto regulation.
Final question for this part. If you were launching a crypto startup, where would you set up shop?
I'd go for a jurisdiction that's legally clear, pro-innovation, and collaborative, like UAE, Singapore, or Brazil. If you want to explore untapped markets, Vietnam or the Philippines offer huge potential, especially in this transition phase.
We've covered a lot, from global giants to agile emerging markets. So now, Henry, let's look forward. Where do you see crypto regulation heading in the next 5 years?
There are three major trends shaping the next chapter in crypto law. Number one is global cooperation. Countries are starting to realize that fragmented regulations are bad for both innovation and enforcement. We'll likely see more collaboration, especially on anti-money laundering, AML, cross-border taxation, and stablecoin oversight. Second is regulatory divergence. While some nations will create crypto-friendly frameworks, others will continue to restrict or ban it outright. The divergence will largely depend on political ideology, economic maturity, and risk appetite. The last one, pressure from emerging technologies, central bank digital currencies, CBDCs, artificial intelligence, AI, and zero-knowledge proofs, ZKPs, will force regulators to catch up faster than before.
Do you think we'll eventually see a global crypto rulebook, something like the WTO for trade?
That's the dream, but it won't be easy. Global crypto harmonization is incredibly complex due to different financial systems, legal cultures, and political agendas. However, institutions like the FATF, IMF, OECD, and G20 are working on standardizing AML practices, tax transparency, and stablecoin disclosures. If we get a baseline framework, just like the Basel Accords did for banking, it could provide a universal foundation, but enforcement will still be up to each country.
How do new technologies like AI and CBDCs actually shape the future of crypto regulation?
Great question. Let's break it down. AI allows regulators and firms to scan blockchain data in real time to detect fraud, track suspicious transactions, and even predict illicit activity using behavioral models. This could transform compliance from a reactive process to a proactive one. CBDCs, when widely adopted, will put pressure on private stablecoins. Governments will have to decide, do they allow both to coexist, or do they regulate stablecoins out of the market? Countries like China clearly prefer control via CBDCs, while others like Brazil seem open to both. And then there's privacy tech. Tools like zero-knowledge proofs, ZKPs, are empowering users to prove things without revealing data. Regulators will have to wrestle with balancing privacy and compliance.
So, if you're just a regular investor, what should you do when laws in your country are unclear?
Here's my 3-step advice for everyday investors. Firstly, use reputable, regulated platforms. If your local laws are murky, use exchanges that are compliant in stricter jurisdictions like Singapore, the EU, or UAE. Second, limit exposure. Don't put more than 5 to 10% of your portfolio into crypto unless you truly understand the space. Volatility and legal risk are both high. The last is, stay informed. Crypto laws can change overnight. Subscribe to legal updates, follow official regulatory websites, and join communities that track these changes.
And for founders and startups, can you still launch a Web3 project during this regulatory uncertainty?
Yes, but with strategic foresight. This space is still building, and early movers can thrive if they play it smart. Here are 5 principles. 1. Choose the right jurisdiction. Set up in countries with sandboxes, progressive regulators, or crypto-specific licenses, like Singapore, Dubai, or Switzerland. 2. Work with specialized legal advisors. You need lawyers who understand token structures, KYC, DAO governance, and cross-border compliance. 3. Design flexible legal structures. Many founders now use a multi-entity structure, like separating token issuance, product development, and IP. This allows them to shift or adapt as laws evolve. 4. Use compliance as a feature. Being transparent and regulatory friendly builds trust with users, partners, and investors. 5. Build for the long haul. Avoid gray areas like unregistered securities or aggressive airdrops unless you fully understand the legal implications.
That's incredibly helpful. Do you think crypto companies will eventually need the same level of compliance as traditional banks?
In many ways, yes, especially custodial platforms and stablecoin issuers. They'll likely face requirements around capital reserves, audits, transparency, and licensing. The line between fintech and crypto is already blurring, and regulators will want consistency.
Let's zoom out. What macro forces will shape the future of crypto law over the next decade?
There are 5 major forces to watch. 1. Geopolitics. Nations may use crypto policy as a soft power tool. Friendly regulation could attract talent, capital, and strategic advantage. 2. Monetary sovereignty. Central banks will resist anything that threatens their control, whether it's Bitcoin, stablecoins, or DeFi lending. 3. Environmental impact. Regulations around mining, especially proof of work, will increasingly focus on energy usage and carbon footprint. 4. consumer protection. After events like FTX or Terra's collapse, governments will demand stronger safeguards, proof of reserves, clear disclosures, and custodial insurance. 5. Public pressure. As adoption grows, voters will demand clarity. This could force reluctant lawmakers to finally pass crypto legislation.
You've given us a clear map. So if you had to sum it up, what's your single biggest message for both investors and builders?
Regulation isn't the enemy of crypto, it's the path to scale. Crypto started as a rebellion, but it will mature into a global financial infrastructure. If we want mainstream adoption, institutional capital, and real-world integration, then we need rules. Not rigid ones, but smart, adaptable ones. So, don't fear regulation, understand it, anticipate it, and design your strategy with it in mind.
That's powerful. So in short, move fast, but build legally. Be bold, but also be structured.
Exactly. Innovation and compliance aren't opposites. In fact, the most successful Web3 companies of the future will master both.
Thanks so much, Henry. That was brilliant and truly eye-opening. And thank you all for tuning in to Descript with Henry. Don't forget to subscribe for more sharp takes on crypto, tech, and the future of finance. We'll see you in the next episode.
Thanks, Lisa. Always a pleasure.